morning, everybody. And thanks to Chris for updating us on the GDP figures out this morning. They weren't as great as we would have liked, but I think we're going in the right direction at last. And I'll give you the data to support that. I'm trying to be a bit more optimistic. I've been accused of being pessimistic for a very long time, but that's the reality, of course, of the economy. So without further ado, let me just describe a term that's become very popular these days, although it's not a new term. The abbreviation is that now we're in a VUCA world. VUCA is the new normal. But, you know, for many companies, that's going to be of concern. But for many others, it's going to be exciting. For many of you, you may enjoy volatility, uncertainty, complexity, and ambiguity. It certainly is not a boring business environment today. And the factors that Chris mentioned earlier obviously impact all of us. But this is not intended to be a pessimistic view of the world. It's simply a realistic statement which says we are in a new normal where the past will not necessarily reflect the future. And the past, you know, in the distant past, we've had some good years, but tough in recent years. So VUCA is the new normal. And again, just a little thought here, and I think I used this last time, a little apology in many ways. Prediction is very difficult, especially if it's about the future. You may recognize the name Niels Bohr. If you've seen the movie Oppenheimer, Kenneth Branagh acted this part. This was a Nobel laureate in physics, theoretical physics, in 1922. And goodness me, what he said then is absolutely relevant today. So I'm not going to suggest, and I don't think anybody should suggest that we can predict the future with great accuracy. The VUCA world is creating so much uncertainty that I think we've got to be, you know, practical and realistic here as well. One other little concept to finish in terms of getting your minds in gear is a wonderful little tool here used in management. And I'd recommend that you practice it in your team meetings. It's the reflective model. You know, what is happening? We're going to discuss that in a few moments. And of course, from your perspective, the big question is, so what? How does that affect your business? So does this morning's GDP figures impact your business if you're in the service sector or manufacturing, financial services, or whatever? So the so what is a question that I'm sure you address on a daily basis. But then the now what is really, what are you going to do differently? Or do you have to do anything differently? And this little, as I say, reflective model helps us just to focus our mind on perhaps the most important issues impacting our businesses. So on that note, let me jump straight into the global economy first. Very briefly on the global economy, although I think we will all agree the global economy is very important to the UK, and for most of us, if not all of us here, it's important to you as well. But it depends on what your business does, of course. In terms of the global economy, these are the latest figures from the IMF, and there are many other figures available, but they're all saying pretty much the same thing. This year and next year, the global economy is still growing, so let's be positive. 3.3% is expected this year, the same as last year. There may be a slight downturn, very slight downturn next year, largely because of trade tension still prevailing. If you look at the USA, however, it is predicted to slow down next year. A little pickup this year and a slowdown next year, perhaps to 2%. That will not make the US president happy, of course, because he wants to make America great again and make it the fastest growing economy. The euro area, again, could be stronger, but we are expecting positive growth, actually very similar to the UK in many ways, 1.3, 1.4% this year and next year. But the area that I tend to look at most is the one below that, the emerging and developing Asia. You'll notice last year, 5.4%, this year predicted to be 5%, so a slowdown and a slowdown next year. To a large extent, that's because of China. The Chinese economy is still going to grow at about 4%, but the region as a whole will feel the effect of a slowdown in China. And that's not necessarily bad news because China, I think, is consolidating. They perhaps expanded too quickly in previous years. The country that I tend to look at most these days in terms of the emerging markets is India. India is still growing very, very strongly. Perhaps I think last year was 7.5%. This year could be 6.5%. So India is doing very well indeed, but from a low baseline, of course. And it has a lot of challenges. Of course, poverty and the political situation is quite chaotic at times, and I say that with respect. But it has more than 200 political parties. But still, I think it's entrepreneurialism, its dynamism will drive India forward, I think, in the years ahead. And I suspect in 20 or 30 years' time, we will start to talk about India in the same way that we've talked about China over the last 20 years. In other words, a strong, growing economy. That's what I hope will happen, because it's nice to think that many more people will enjoy a higher standard of living around the world. And there are other parts there you may want to look at briefly. Now, just very quick summary on the inflation outlook across the world. We have come off those peaks, of course. Global CPI is gradually trending lower, and that's great news. And we expect this year it's going to fall around to about 3%. Still a bit higher than what the IMF would like, or the World Bank, or the OECD would like. But nevertheless, we're off those peaks that we had just a couple of years ago, which is good news. The US inflation, a bit like the UK inflation, is proving to be rather sticky to get it down towards the Fed target of 2%. Let's see whether or not the new Fed chairman, when he comes in May, will have any impact on the voting of the Federal Reserve Board. I suspect not, by the way. I think the Fed are going to remain cautious concerning inflation for some time, particularly because of service sector inflation. The Eurozone, in fact, inflation is below 2% now. It'll go back up a little bit more, but it's on target. The inflation in Europe is now under control in general, not in every single country, of course, and that's largely the effect of lower energy prices feeding through. Remember, they spiked a couple of years ago because of the Ukraine situation, and that spike has now come back down again. So that's, again, good news. But we didn't win any gold medals or any medals in the Winter Olympics so far, but we can celebrate the fact that we have got the highest inflation rate amongst the G7 countries. The latest figures for December were 3.4%. But I think there is good news here. We're going to see the latest inflation figures for January coming out next week, and I'm expecting them to show a significant fall, perhaps to 3%, maybe even 2.9. So we are absolutely expecting, very confidently, and I hope I'm right, inflation to track down a little bit faster than we had expected just a few months ago. Now, that is good news, but it's not over yet. The fight against inflation will take some time. Boy, and if we think we have inflationary problems, you got to look at some other countries around the world, such as Turkey and Argentina. And I checked the figures again just last night. They're still around about 30%, just over 30% in Turkey and Argentina. But they have come off the peaks. They were up to 60, 70, 100, 130%. So they've still got tough times there. But Latin American inflation is generally falling as well. So the inflation picture compared to 2 or 3 years ago, goodness me, a significant improvement and more to do. But getting inflation down lower, back down to targets, of course, will prove a little bit harder. It's the incremental improvements will not be so easy to achieve. So in terms of the global economy outlook, I just identified what I think are the 6 big issues, and I'm sure there are many more as well. The big issue is inflation is lower, but it's not yet over and out. It's the inflation risk still persists, and hopefully things will improve as the year progresses. Monetary policy is eased, interest rates have come down, but I don't think we can expect interest rates to go back to where they were during the pandemic, for example. We had historically low interest rates then. I do not expect that to happen again. In fact, I don't want it to happen again, because they were a sign of economies in crises. Of course, we're all talking about this in the UK, and it's a global issue. Public finance pressures continue. Governments during the pandemic, borrowed so much money that all governments are under pressure. And that's going to create limits to fiscal policy, which means they've got less room to stimulate their economies. And as Chris mentioned regarding the tax burden in the UK, it has gone up significantly. And that's true in many parts of the world. So we're not alone, which is in some ways good news. And of course, the news is full of this. The geopolitical situation and the what I call economic fragmentation is a real problem. The traditional trade alliances, the traditional global relationships are changing in real time before our very eyes, which I think is remarkable to witness, sadly as well. And so I think for all countries and all companies, I think in this rapidly changing environment, resilience is going to be number one challenge for all of us, just to keep control of our businesses. And of course, I can't discuss the economy without mentioning at least technology and the AI revolution that is hitting us. A lot of people have question marks about AI. Will it create jobs or destroy jobs? Will it increase productivity for some sectors? But what about other sectors? What about public sector and so on? But I think the key point is, technology is here to stay. AI is a reality, but I think it's about how you execute that AI strategy. That's critical. Just talking about it doesn't make your strategy successful. You've got to be very, very careful about this. And of course, I think in every presentation, we must mention the climate risk. It was good to hear this morning that China's emissions have shown a small decline in their fossil fuel situation. So that's a slight improvement there. But this is a core risk for the global economy. And I'm certainly not going to say anything different from that. I think it's critical that we all are well aware of that. So look, I'm sure there are many other big issues that you've got in your mind regarding the global economic outlook, but those are just some things to consider. And I mentioned that this changes in the geopolitical alignment and the global alliances. I want to summarize this in what I call the changing spheres of influence. Throughout your lifetime, throughout my lifetime, the USA has been the dominant sphere of influence, and the countries aligned are linked to the USA in terms of trade and politics. We think of the Western Alliance, but as we've heard recently, that is changing. The US president is of the view that the Western Hemisphere is his, and the US focus is changing. We can talk about it, we can argue about it, but I think the reality is there is a change taking place that we've all got to appreciate has fundamental implications for the global economy and for our own economy. Of course, since the Treaty of Rome in 1957, the EU has been and is a major sphere of influence. But I won't go into detail, but Brexit has impacted this. You can read on the BBC website this morning regarding the Chancellor's view about the need for closer trade relationships with the EU, because the EU is still by far our biggest trading partner as a group of countries. It is critical to our trade future. So I won't go into detail. You can read about that as well later if you wish. But the EU's influence has changed. And then, of course, China's has increased dramatically. And remember, when I say spheres of influence, I mean the countries aligned around these three major powers. So the countries that are realigning around China, think, for example, of the scale of China's investments in Africa, as an example, and other parts of the world, and how those countries are becoming closer in terms of trade relationships with China. And I have to say, I respect and I admire China's strategy. I've often called their development of their global strategy, I've often called it new or a modern colonialization in terms of using trade as a way to bind countries closer to them. And I think this is incredibly smart for the long term, because this is about China's future trade relationships. But then where does that leave the USA and their trade relationships and the EU? And of course, where does that leave the UK in terms of its trade relationships? We're having to do deals with individual countries, but the biggest trading bloc is the EU from our perspective. So again, I don't want to go over it and rehearse the Brexit debate. That's gone. But I think the future is what I'm focusing on here. So without further ado, let me now turn to the UK economy. And I think that's really the main topic of interest today, I'm sure, for all of us. And I'm going to bring you right up to date. Now, next week, we've got a whole raft of economic indicators being released by the ONS. We had GDP this morning. Next week, we're going to get the latest unemployment figures, the latest figures for earnings growth, the latest figures for labour productivity, the latest figures for inflation, and the latest figures for the government borrowing. All of those, MHA will have media commentary releases all next week. So hopefully you'll follow some of those in the press. So, and I'll bring you up to date on my views as well. In terms of the state of the UK economy, where are we now? Well, as you just heard, 2025, we had growth of 1.3% and 0.1% in Q4. So the reality is the economy started off very strong at the first quarter of last year. And then as the year progressed, growth slowed down, but we still ended the year with overall growth of 1.3%. In November, we had quite a little surge in November of 0.3, which was better than forecast. But then December slowed down again. I'll show you the figures. And inflation, I mentioned earlier, is still a problem, but going in the right direction. It went in the wrong direction between November and December, but I am very confident it will be going in the right direction as we progress when we get the figures next week for January. Food inflation is still a problem for many households, and cost of living, of course. And that will take some time to work its way through the system. Consumer business confidence remains fragile. I'm going to update you on the latest figures for consumer confidence. The GfK, Growth for Knowledge Confidence Index, is very, very popular and I think highly respected. And I'll update you on the latest figures for that as we go through this presentation. But as I mentioned earlier, all countries are facing the same challenge. And you may have heard this discussed on Radio 4 this morning at about 7:15. The scale of public sector borrowing and welfare spending, largely due to the escalating welfare costs and pension costs and healthcare costs. The reality is, as we grow older, we need to grow older in a more healthy way. And I'm going to spend some time on this topic, by the way, because it is a hugely important topic. And I'll bring you right up to date with the data on that as well. So that's just a general picture at the moment of the state of the economy. Here's the latest monthly figures. Again, I didn't put another slide in this morning, but Chris has updated us on the quarterly data. Here's the monthly figures. You'll see that November figure had a nice little update. And so, we've had some good months and some not so good months. But by and large, as I say, things could look a lot worse. And I'm beginning to feel a deep sigh, a deep breath that we've turned the corner. But I'm not going to exaggerate. It's still going to be a challenging year ahead. And I'm really hoping for stability, particularly in terms of policy and taxation. So I'm hoping nothing will happen in the spring statement that creates that stability for you in the business sector to begin to plan ahead with more confidence. Now, let me look to the future. All I've done here is take a screen capture of you'll see the OBR report and provided by the ONS. The yellow columns, they show you what the forecasts were for growth up to the end of this decade before the budget in November. And then we had the budget in November, and the blue colored columns show you the new forecasts. And you can see very quickly that from 2026 onwards, the new forecasts are lower than the previous forecast. What that says is the budget in November has suppressed growth forecasts for the next 5 years to some degree. But look very carefully at the data. We're still expecting, the OBR is independent of the government. It's independent forecasting organization. They are still expecting growth of round about 1.5, 1.4% year by year by year to the end of the decade. Now, that's good news. I wish it were higher. The budget hasn't helped, but it hasn't completely stifled us. To put this in context, between 1970 and 2010, that's a long time period, by the way. If we take that as a long enough period to identify a solid trend, the trend rate of growth, the average rate of growth over that period for the UK was about 2.5%. Looking since 2010 and looking ahead to the end of this decade, the trend looks like more like 1.5%. Now, that's not as good as I would like, but let's be realistic. What it's saying is we are now in a new normal. It'd be wonderful to think of booms and 3-4%. I think those days are gone. We've got to adjust to a new normal, and 1.5% looks to be pretty well established. But will AI change our trend? Will AI push us onto a new, stronger growth path? To be discussed. Also from the OBR report in November, again, you'll see the left-hand diagram. It shows you labour productivity, which we'll have a press release on that next week. Before the budget in November, we expected labour productivity to improve year by year by year. And the budget has suppressed those forecasts. And you'll see there, perhaps by the end of the decade, labour productivity might be as high as 1% in that year, improvement. But that really isn't enough. Look at the right-hand graph. You see the green dotted line shows you what the trend productivity level would have been if we had grown on the long-term average, the pre-financial crisis average, before the financial crisis in 2008. But since the financial crisis, our productivity in this country has been very disappointing. And you'll see there are various graphs to the right, or below the green dotted line. But the one that we're really interested in is the November 2025 forecast. And as you'll see, it's compared to where it should be, our productivity is well below that. So we got to just wake up and realize our productivity is not good, and we need to do something about it. Now, I won't keep mentioning AI, but AI is one possible stimulus to productivity. Of course, we need to also invest in people, not just technology, but people, infrastructure. We need to get goods moving around the country much faster, information flowing faster, skills that are more adaptable. So we desperately need to focus on, improving our productivity right across the economy, especially, by the way, if I may say so, in the public sector. Again, you can follow all of these reports. I've given the sources there, and they're all freely available online. Now, one of the things I mention in every presentation are the government borrowing costs using the 10-year government bond yield as the benchmark. And this is, I took this February the 7th. I've checked this morning. It hasn't changed very much, by the way. It's still about 4.5%. And the source is there to be checked very, very easily. Now, let me just stress something. 10-year government bond yields are critical to all of us. Obviously critical to the government because it represents the cost of their long-term the cost of the bonds, the yield on the bonds. You'll notice, by the way, on August the 2nd, 2020, our bond yields were at the lowest in our history at 0.11%. Incredible. We will never see that again. You should never say never. But this was almost entirely because of quantitative easing. The Bank of England, they were buying bonds, pushing the price up and pushing the yield down. Now, everybody in finance understands how bond yields are derived. I don't need to explain that to you. But of course, then we had the Liz Truss mini budget, the quasi-quartine mini budget, and the financial markets became a bit nervous about that budget, and there was a spike in bond yields. But if you look carefully, you'll notice that bond yields have gone up since then and have remained, round about the 4.5%. And they go up and down a little bit on a daily basis, but I think we're now probably where we're going to stay for some time. It's reflecting the financial markets' view of risk in the UK economy, risk of lending to the government. There's political risk as well, by the way, which affects these figures, and the long-term growth forecast. But please remember, 4.5% bond yields historically is not that high. If you go back 20, 30, 40 years, they would be quite sensible, normal bond yields. The reason why I'm just stressing this is because the cost of government finances based on bond yields is the benchmark for the cost of business loans, for the cost of capital. And of course, if you've got a fixed rate mortgage, the fixed rate mortgages are linked to bond yields. So this affects all of us significantly. So I think that the moral of the story is, in terms of cost of capital, if you're AAA rated, you're probably borrowing similar rate as the government, maybe 4.6, 4.7%. But then you've got to make a return on that capital. So you're probably looking at 7, 8, 9, 10%. So some projects become difficult to justify as the bond yield goes up. But again, you in finance, you will understand that much better than I do. So the moral of the story here is, or the conclusion is, I think we're probably, unless there's some other huge concerns or risks that arise, I think bond yields at about 4.5% are going to remain with us for the foreseeable future. Now, I thought I'd do a quick comparison of the bond yields across the world. And again, the Haver Analytics and the OBR produced this graph very helpfully, by the way, up to the end of 2025. If you look very, very carefully, you'll see that the yellow line represents the UK. In other words, again, we didn't win the gold medal, but we have got the highest bond yields amongst the G7 countries. And I checked that again last night. It's still the case. What that says is, again, the global financial markets, in looking at the UK, they see more risk, political risk, economic risk, trade relationships. So the government needs to work very, very hard. And I'm not being political. We all need to work hard at creating a stable business environment that is attractive to investors, to those who've got the capital to invest in this country. That's critical for all of us. And the USA, by the way, is also quite high, as you'll see there. Obviously, Europe tends to be lower, traditionally lower. The euro and the strength of the German economy, which has got problems, has kept their bond yields quite low. Now, looking ahead, again, I'm taking the OBR report and pushing out to 2029, 30. The government, in setting out their budget in November, has really stuck to their guns, as based on the previous government's direction of travel. The annual borrowing is going to come down. Now, it's not a big surprise, given that, for example, the tax thresholds have been frozen now out to 2031. So, as Chris mentioned, the tax burden earlier, it isn't going to come down. It's going to keep on rising to some extent. As a result of that, then the government's annual borrowing as a percent of GDP will come down. You'll see even, the March forecast and the November pre-measures forecast, then the November forecast, they're all giving a very, very similar picture. We have now, the government has now put in place all of the decisions, all the steps to force government borrowing down. And as the economy grows, of course, that will make these forecasts much more achievable. So I'm hoping growth not only is at 1.3%, but I'm hoping it improves slightly, because that will make things a bit easier before the next election to cut taxes. Am I being cynical? But we'd all like to see taxes a bit lower, I think. In terms of the public sector net debt, and we'll get the latest figures from the ONS next week, next Friday, I believe. Again, under all the different forecasting reports, March, November pre-budget, November, they're all saying pretty well the same thing. Our public sector net debt, the national debt as a percentage of GDP, is going to remain close to 100% for the rest of this parliament, because it's a mountain of debt. Imagine a snowball on top of a mountain covered in snow. As you push the snowball down the mountain, that represents annual borrowing. But you've got a huge snowball already. So we're going to add a bit less each year, but we're still going to be adding to the total debt. And as I say, unless the economy suddenly goes into a boom, we're not going to see much change in the percentage here overall. But I want to focus on this because this really is a critical challenge for all of us. The national debt is huge, but It's the cost of servicing the debt that really matters. You may have a huge mortgage, but if the cost of servicing it is very small, it's affordable. Well, look at the bond yields. The bond yields have gone up by 4.5%. So the amount of tax revenue that we're paying to the government to service the national debt has gone up significantly. More than £110 billion of interest is paid each year from our tax revenue, from our tax payments. So we need to we got to stop the debt rising. It would be nice if the bond yields would come down a little bit, but of course, growth is the answer to many of our problems. Now, longer term, and this was discussed on Radio 4 this morning, so you're hearing it here as well. The longer term outlook is very, very important. It's based on essentially on demographic projections, aging populations, and so on. And as I say, if you were awake this morning and you heard it in your car on the radio, there is a concern that the national debt that I've just shown you a moment ago, which was nearly 100% of GDP, it could, and I stress the word could, it could treble over the next 50 years. Now, you're probably all thinking, this is not my problem. It is your problem, because this is the aging pop. You're all going to be aging, I hope. It's not my problem. I'm definitely past this point. But, you know, as we get older, some of us will become less healthy. Some of us will be on pensions. Healthcare costs increase. And so this is a projection that is a serious one to think about, by the way, because it isn't going to go away. It's a reality. It's based on the independent research carried out by the OBR, and there's three big reasons. I've mentioned one already. It's the aging population is the primary reason for this, the primary driver of our debt rising. We've got to do something about this. But the more we delay, the bigger the problem becomes. It's also a cost of climate change to factor in as well. So it could be higher than 300%. And then, of course, the geopolitical tensions, the amount of more money we're spending on defense and the wars, etc. Sadly, this could become even a bigger challenge than we expect, just based on an aging population. And then, of course, you've got, possible diseases, pandemics, cyber conflict. Goodness me, I mustn't say any more about this. But we can stick our head in the sand and ignore it, but it ain't going to go away. So let me show you by the way, the OBR, these are their words. They believe that this is an unsustainable path. And the solution is, well, either more tax revenues, even bigger tax burden, or we need growth. And that requires productivity. Remember, investment is the engine of growth. We need to keep investing in public sector and private sector, grow our product to increase our productivity, to grow the economy, or else we're going to have to pay higher taxes. It's hard to square the circle any other way. Now, if I move on then just to I've given you enough of the negative news. Let's now look at the latest forecast for the economy as well in terms of interest rates and inflation. First of all, where are we? Well, interest rates didn't change at the last meeting of the Monetary Policy Committee. Interestingly, by the way, the MPC vote was 5-4 to keep interest rates at 3.75%. The head of the Bank of England, he had the casting vote, and he went for no change. So it was a very close call, 5-4. Now, the next meeting, I think, is on 19th of March. And given how close that call was, and given that I think inflation will be moving downwards before the 19th of March, then I think, I'll put a penny on this. I think we'll see an interest rate cut in March, which is sooner than I expected, by the way, even a month or two ago. But I'll stick my neck out there and say as a possibility, not a certainty, that we'll see an interest rate cut at the next meeting of the Monetary Policy Committee. They say the rates were held on the 5th of February. There's the vote, 5-4. That was interesting. And of course, in terms of inflation, I mentioned already, we're off that peak. That peak was 11.1% a couple of years ago. Thank goodness we're off the peak. And we did get inflation down to the 2%, and it went back up again largely for external reasons and because of labor shortages and sticky wages. And it peaked, it went up again in December. You'll see that 3.4. But again, I do expect next week, I think it comes out on Thursday, Wednesday or Thursday. I forgot which day it is, but next week we will get the latest inflation figures for January. Boy, I'm very much hoping we're going to see inflation going down towards the 3%. And then the Bank of England has signaled already at the meeting on the 5th of February, they think inflation will get closer to 2% sooner than expected. So they are, feeling very confident that inflation will be tracking down in the coming months. And the Bank of England governor has signaled and he can't be too explicit. He has signaled that interest rate cuts are on the way. But again, I'm not expecting a dramatic fall in interest rates. I think it'll be very gradual. There may be 2 cuts this year. 3 cuts is possible, but I just don't want to, be over optimistic in that respect. Now, in terms of the forecast, again, this is going out to 2031. You'll see here, the Bank of England and the OBR, in terms of at the budget in November, they put together their assessment. So we're expecting, you'll see interest rates to come, you'll see the dip there in the grey shaded area. So we're expecting them to come down, maybe to 3.5%, maybe 3.25, a little bit of variability here. And then they may track back up a little bit towards the end of the decade. And that's not a bad thing, by the way. The Bank of England would like to have interest rates a couple of percent above the base rate, above the inflation rate. The reason for that is they do want to maintain some leverage over us. When interest rates fell to the lowest in history, you remember the base rate did fall to 0.1%. This became known as pushing on a string. They were ineffective. We lacked such confidence. The economy was on its knees that lower interest rates didn't stimulate us to borrow and spend. So they lacked a bit of leverage, a bit of room for maneuver. So, that's their projection, that they think will go towards 4% when inflation goes to 2%. And that would be a very healthy situation to be in, by the way. You may not like the high interest rates, but it's a healthy situation to give the Bank of England a bit more control over our behaviour. And in terms of inflation, again, most forecasts are saying pretty well the same thing. Inflation is going to track down to 2%. Perhaps a little bit sooner than we expected just a month or 2 ago. But let's see what next week's figures give us. But there's unless there's some external, geopolitical crisis again, like we saw with the Ukraine situation, we will start to see us, move back towards target of 2% in the coming months. It just depends how quick we get there. So that's the outlook for the rest of this Parliament, which will not look too bad if these predictions are correct. But prediction is very difficult, especially if it's about the future, just to remind you of that, by the way. In terms of the labour market, and again, we're going to get the latest unemployment figures next week. Again, unemployment at the moment is 5.1%. I'm not expecting much change next week, but it has been edging up in recent months. I think we're going to probably stand still for the latest figures that'll come out next Tuesday, I think it is. So 5.1%, whether it's 5.1 or 5.2 is neither here nor there. It's higher than what we would like, that's for sure. And there are some problems. Again, you may have heard this on the radio this morning as well. They must have been watching, looking at my slides in advance. More than 9 million people in this country who are of working age. This is the official classification, 16 to 64. Over 9 million are classified as economically inactive. So of working age, but not in work. And that's a record high inactivity rate of 21%, by the way. 21% of the working age population. That is not good. It's also very expensive for the economy. Some of these people, of course, are going to be on welfare. Some may not be on welfare, but gosh, if only half of us work, the other half had better work. We've got to work twice as hard to maintain everybody else's, as it were, living standards. So we need to get this situation changed. And about 30% of this, roughly 2.78 million, are categorized as long-term sick. Again, another record high. Now, long-term sick, for many reasons, by the way. I'm not making any judgments about people's sickness. That's for the government to sort out, what they can do about this. But it's the financial cost of this, which is a key point to note. Oh, by the way, of the 9.1 million economically inactive, that also includes students of working age. So let's not pick on university students, please. But youth unemployment is a problem. And it's been a problem for decades. It's a problem in most other countries, by the way. The younger workers are getting, the hardest time. The unemployment in the UK amongst the youth is currently 13.7%, the latest figures. Again, we'll get that updated next week. We just need to get the right training programs, the apprenticeship situation improved. We need to get the skills improved. We need to focus on this, because the longer young people are unemployed, the danger is that they lose the ability to work. I mean, they become unemployable. The skills become redundant, especially if they haven't got any new skills. So we need to help these young people into jobs. And of course, in some sectors, as you will know better than I do, there are labour shortages still in many sectors, particularly in the service sector. Again, that's a sign. That's an indication of you've got 9 million people economically inactive, and yet there are some sectors facing labour shortages, which obviously puts pressure on wages to attract young people or attract anybody into those jobs. Now, the thing I'm going to focus on in a moment is the looking ahead to real earnings growth. In other words, earnings allowing for inflation. Sadly, we're going to see minimal real growth in earnings, as you will see in a moment, and that's why the cost of living crisis it feels like it's almost a permanent problem, or it feels like it's prolonged it's too long. But I don't think it's going to go away any day soon. And job vacancies have been falling for the last 3 years. Now, again, that's a sign of lack of confidence in some businesses, being wary of recruitment. There's the national insurance costs. There's the labour workers' rights and so on, the change in rules. And then, of course, there's the AI revolution taking place. So all of this is going to, have an impact on the extent to which companies recruit people. And yet, in some sectors, we've seen falls in employment. Again, technology being one of the causes of that. So labour market is really quite a challenging part of the economy. Again, we'll hear more about it next week. In terms of the real hourly earnings that I mentioned, this is going out to 2030 again, based on the OBR report. Look very, very carefully. The blue line is the one based on the November budget. And you'll see very clearly that real hourly earnings have increased, or expected to increase this year, but then expected to decline. And for some years, we'll have very little growth in real hourly earnings. That's unfortunate. Excuse me. So again, living standards are not going to suddenly jump up. Well, they'll a little bit this year, but then they'll flatten out again as the tax increases begin to bite. In terms of employment, I mentioned it earlier, some sectors have seen employment fall, while some have seen it rise. And these are the latest figures, by the way, up to December. So it's the year from December 24 to December 25. We've seen falls in wholesale and retail, accommodation, food services, and so on. We've seen rises in some sectors, particularly health and social work. Again, perhaps some of you will recognize some of those changes taking place. Okay, so I'm conscious of time, by the way, and I said I would come back to this. In January, just a few weeks ago, GfK, Growth for Knowledge, came out with their latest consumer confidence index. Very, very respected organization. And you look very carefully at the latest, on the right-hand side, the latest data. It's showing consumer confidence is still in negative territory, but it's improving a little bit. But consumers still feel the economic turnaround is not yet having a big impact on their confidence. So they're far from feeling good about the economy. But what's interesting here, if you look at this, it's now a decade since consumer confidence, based on the GfK index, since it was in positive territory. I think that's remarkable. In other words, for a decade, consumers have not been feeling as positive as we would like. Now, why do I stress this? Well, a very simple reason. The consumer is king. The consumer is the biggest part of spending in our economy. We, the consumers. If consumers are not feeling confident, then that tends to have a downward pressure on the overall economy because we need to sell. We need to keep on selling to consumers. So it's been a decade since it's in positive territory. I find it remarkable. But let's hope, this direction of change is beginning now to become established. And as the year progresses, that should get a little bit better. But then, of course, for the rest of this decade, probably not the best picture we might want to look at. So, conscious of time, in terms of economic growth, just to update, growth is recovering. 1.3 last year. Next year, probably very similar. 1.4 is possible. 1.5 will be great. Government debt is remaining high. That's not going to go away. And as a result of that, and the interest rate burden, the Chancellor's headroom will remain thin. And then, of course, that headroom can be wiped out by external or unforeseen events, as we've had before. But, let's hope things stay calm. Inflation is set to fall back to target. And I just want to put a little clause here, subject to what, may happen in the rest of the world, particularly from the US president, which can have an impact on us through tariffs. But again, all things being equal, we're beginning to see some light at the end of this tunnel. The Bank of England has signaled that there will be interest rate cuts ahead. They're not going to be precise. They just signaled this, and that's to make us feel a little bit more optimistic, but not going crazy here. As I've shown you a few minutes ago, minimal growth in living standards for several years ahead. And then the labour market challenges, I think they really are the big challenge, youth unemployment especially, and then the impact of AI on workers in the future as well. And of course, trade disruptions haven't gone away. Again, fingers crossed on that one. So just to finish my last slide, and I'll leave a few minutes in case there's any questions in the chat box that Chris would like to raise. Here's a comment that I made just over a year ago, and you can find the actual article if you wish. The reference is there. But just to leave you with this thought, in terms of the VUCA model and the impact of so many different forces driving change, I think the next 5 years will see more change in business than the last 50 years. Why 50 years? Well, 50 years, the idea comes from Kondratiev cycles, is the idea that changes in technology in the past took a long time to impact our lives, our economies. This is called the Kondratiev wave or the long wave cycle. But the long wave cycle has become very short. AI, I believe, will have a much bigger impact than we could possibly have imagined 5 years ago. And so forward-thinking leaders like yourselves will need to focus on the future as well as where we are today, the current challenges, as we enter an important period of change. I will stop on that note. And as I say, Chris, if there's any questions that have come up that you'd like me to address, I'm happy to leave a few minutes for that. Thank you very much, everybody.
Fantastic. Thanks, Joe. An incredible amount of insights in a relatively short space of time. So thank you for that. Just one comment and one question, actually. The comment was around, you see the global trends, interest rates dropping, hospitality sector struggling. So I found it fascinating that the Barmy Army in Australia for the Ashes not only created a massive boost for the hospitality sector, boost up inflation, and has resulted in interest rate increases in the short term. So a lot of Australians unhappy about that, even if they are happy with the result, which is different to our experience. But the question for you, Joe, as you know, I love the investment is the engine of growth.
Yeah.
If you're sitting in government or in the Treasury now, and you can sort of influence one policy to help investment, what might that be?
Great question, Chris. And you probably can anticipate my answer, which is the same thing I said 2 budgets ago in November 2024. And I said it then, and I've said it last year, I'll say it now. If the government is really serious about boosting growth, investment, the corporate sector, we need to reduce, the national insurance on employers and corporate tax. And I really mean that. And I'm not a tax-cutting, right-wing radical economist. I just think, look at the countries around the world that have performed very well. But and I shouldn't mention Ireland too many times, but tax revenue is booming. Goodness me, they've now got a sovereign wealth fund. I think the tax burden, which you mentioned, has risen significantly. That includes the corporate sector. And I personally would just, take a deep breath and make that decision. I'm not suggesting huge cuts, but signal to the corporate sector that we're here to help you, not just through, words, but through action. So I'm sorry to stress that, but I really do believe that's the way to get this economy moving again.
No, great point, and totally agree there, Joe. And just to reiterate the thanks from everyone that's come through, etc. Yeah, very insightful, and
Thank you for that.
gives us a lot to think about. Really appreciate it.